this is Ken Finnan from Capital Advantage Tutoring, and it's my job to get you to pass the Series 7 and the SIE and the 65, 63, 66, 24, all the FINRA exams. It's my job to get you past it. I'm going to use my 20 years of experience in explaining stuff in normal English. I also have a podcast, Blue Collar Finance, that is kind of crappy, but we're working on it and it should get better. So the topic today is going to be taxes. So everyone always asks, that's on my lives, I get a ton of questions. Can you explain taxes, taxes, taxes? So they do that all the time. I'm going to kind of put this on vibrate. Hopefully I can do that. Who the hell would be calling me at 11 o'clock at night? I have no idea, but there I am. So there's two types of taxes. There's ordinary income, and then there's capital gains. Just about everything is ordinary income. Interest, dividends, earnings, like salary, commissions, royalties. When you take money out of your retirement account, it's taxed as ordinary income. All of that stuff. Again, the reason they do that, we'll come back to that later. So everything is ordinary income and it's taxed at a ridiculous up to 37, 39, 36, depending on what year you watch this, a very high rate. So that's like when you get your paycheck and you're expecting $1,000 and it's only like $650. That's the ordinary income, that $350 plus other, Social Security and stuff. But really, it could be as high as 36 or 39%, again, depending on when you're watching this. In reality, when you get your paycheck, you actually pay more than one tax rate. You pay a couple tax rates. So the way I explain it is this way. So say you make $50,000. You're actually paying like 4 different rates. So what happens is, because we're going to talk about a thing called marginal and effective rate. So if you make 50 grand, so let's say I'm just ballparking numbers. These aren't hard numbers, but let's say the first 10 grand is taxed at like 5%. So you're going to pay $500 in taxes on the first 10 grand. Maybe the next 10 grand is taxed at like 10%. So you're going to pay $1,000 on that. And then let's say maybe the next 10 grand, but so the first 10 grand, 5%, the next 10 grand, 10%. Let's say we stop at 30 because I can do the math that way. At 30 grand, maybe that's going to be taxed at 15%. So really going to pay $500 in taxes on the first 10 grand, $1,000 on the next, and $1,500. So what is that? 15 plus 1,000 is 25. So you're going to pay $3 grand in taxes on 30,000. So the marginal rate is that 15%, the highest rate. They call that what you're paying on the last dollar you earned, which is up to the 30. The effective tax rate is the actual rate you're paying based on that. So that's a blend of all your rates. So in this case, it'd be like, well, you're paying 15, you're paying 10, and you're paying 5. So that works out to be around 10%. That's your effective rate. So the effective rate is not what you use to calculate anything. That's just fun to know. So the marginal rate is the one that matters. The marginal rate is the top tax bracket. It's on your last dollar. So let's say you're at 30 grand and you're paying your 5, 10, and 15, and you get a $2,000 raise. But let's say that's a new bracket. So you'll get taxed at a higher rate just on the 2 grand. So each bracket you get taxed on, so don't turn down a raise. It's not like, oh, I'm making 30 grand and I get a $2,000 raise. I'll be in a higher bracket, so I'm going to say no. No, you're only paying a higher tax bracket on that higher money. That's why when they talk about raising the marginal rate, it's only the top earners that have to pay that highest rate. Okay, what is ordinary income? That's what we do. If you get a dividend, you're paying that. If you're getting interest, if you have a retirement account and you get paid out on it, when you take it out, you're going to pay your ordinary income rate. Now, the goal on the retirement stuff, the whole point of that is so that hopefully you'll be in a lower rate by then, so you pay less taxes than you would now when you're in your prime and you're paying 39%. Maybe you only be paying like 15 or 20%. Okay. By the way, guys, there's no fucking script here. I'm just trying to riff and try to do this. That's how goddamn smart I am, and that's how much I'm going to help you. I'm totally kidding. I'm a moron. Just ask my wife. I am a moron. Okay. Now, the next thing is capital gains. Capital gains is kind of like a different thing. So we're going to talk, there's long and there's short. So short-term capital gains is going to be taxed just like ordinary income. It's going to be taxed at the highest rate that you pay. But if you have long-term capital gains, which means you've held an asset for more than a year, then you're going to pay a lower rate, like 15 or 20%. 15 if you're normal, and 20% if you're in the top, like 2%. I think it's over 450 grand. Not a testable thing. Just understand. So if you make a lot of money and you have a long-term capital gain, you might pay 20. It's still better than 36, 37, 38, 39%. So long-term gains is what you want. So the IRS is rewarding you for holding something for a long time. So if you buy an asset, and you hold it for over 1 year, more than 1 year, then it's a long-term gain, not a year, over 366 days, a year plus a day, and then you sell it, then you will pay taxes. Remember that. If I buy stock and it goes up, I owe no taxes. I only owe taxes if I buy and then I sell, okay? So if the money goes up, if you put money in, if you buy stock at 50 and it goes to 60, if you don't see them say sell the stock, or you have proceeds or something, you don't pay taxes. It's an unrealized gain. Could be a trick, okay? Now, there are only 3 things that are capital gains. 1, a buy and a sell. A buy is called cost basis. A sell is called proceeds. A buy and a sell, okay? The second thing is option expiration. So if you have an option and it expires, it's either a capital gain or capital loss. If you sell the option, expires, it's a capital gain. If you buy the option and it expires, it's a capital loss. By the way, since options are under a year, it's always a short-term capital gain. Okay. So again, we'll go back to the beginning. A buy and a sell, cost basis and proceeds. Now remember something. Cost basis is what you buy it for. Proceeds is what you sell it for, not your gain. So if I buy stock at 50 and I hold it and I sell it at 60, my cost basis is 50, my proceeds is 60. The $10 is my capital gain in this case. Long or short, depending on how long I owned it. If I have a buy and a sell, that's a long-term capital gain. If I have an option expiration, I'm just stuttering, it's 11:30 at night. Option expiration, that's a capital gain or loss. And the third one is if a mutual fund does a distribution. So if a mutual fund does a capital gains distribution, it is a capital gain. And the magic of that is that if you get a capital gain, that's a long-term capital gain distribution. So even if you bought the mutual fund 3 days before you get this capital gain distribution, it's treated as a long-term for you also. They don't have to worry about that year thing. So 3 things are capital gains. 1, a buy and a sell. 2, option expiration. 3, mutual fund capital gains distribution. Hopefully I read it up here so you can read it. Okay. Good stuff. Now, when we do capital gains, we need to get a cost basis. Remember, cost basis is what you pay. Proceeds is what you sell it for. The difference is your gain. So even on retirement accounts, you pay taxes on everything above the cost basis. So if you have a qualified account, which means pre-tax, we'll come back to the other stuff. If you have a qualified account that's pre-tax, that means you paid no taxes on it. So your cost basis is 0. So when you withdraw it, you pay tax on every penny. But if you have a non-qualified account and you put money in, it's already been taxed. So if you put in 20 grand, that's your cost basis. If you then get rid of it when you retire, that's your proceeds. When you're getting it out, you're going to pay tax on everything above cost basis. But remember, anything to do with retirement account, the IRS goes, no capital gain. It's going to be taxed at ordinary income because they've been waiting 20, 30, 40 years to tax you. No way are they giving you the better rate. Fair enough? Okay. Now, if I buy stock, that's my cost basis. If I pay a commission, that is also my cost basis. So if I buy stock at 50 and pay a $1 commission, my cost basis is now 51. Woohoo, Kenny's so smart. So buy stock at 50, pay a $1 commission, my cost basis is 51. If I then sell the stock at 52 and pay a $1 commission, my proceeds is 51. So I made no money because I paid commissions. Okay, so there are 3 things that do not affect cost basis. So if you buy stock or whatever, there are 3 things. I love the number 3. There are 3 things that do not affect cost basis. So if you buy stock and you sell a call, you buy stock and sell a call, your cost basis is still what you paid for the stock. Selling the call has no impact on your cost basis. Second, number two, getting a dividend has no impact on your cost basis. Getting a dividend has no impact on your cost basis. I'm petting my dog. It looks like I'm moving my arm weird. Again, getting a dividend has no impact. So if I buy stock at 50 and then I get a $3 dividend, my cost basis is still 50. They treat the dividend as what? Oh, ordinary income. Yes, they treat it as ordinary income. And the third thing that does not affect cost basis is accrued interest. So if you buy stock at 900 and you pay $50 in your accrued interest, your cost basis is still 900. It does not impact it. Okay, fair enough, easy stuff. Remember, I'm not going on every part of taxes, just trying to give you the overview. Now, you might see a mention of a qualified dividend. A qualified dividend. If you buy stock and you hold it for 60 days before the record date and 60 days after the record date, the IRS goes, hey, we're going to reward you for holding it so long that we're not going to charge you that ridiculous 39, 37, 36% rate. We're going to charge you only 15 or 20%. It's still ordinary income, but we're giving it what they call a preferential rate. So a qualified dividend means that you're paying a lower tax bracket, 15 or 20, because you've held the stock for 60 days before and 60 days after. Okay. Also, since we're talking about dividends, let's have some fun. So if you are a corporation and you buy another corporation stock, so again, I'm Capital Advantage tutoring a business, and I buy stock in Apple. And Apple pays me $100,000 in dividends. I only pay tax on 50% of it. So the 100 grand I get in, 50% of it, boom, I don't pay taxes on. Okay? 50, boom. That's the advantage of that's called the corporate tax exclusion. They're giving corporate dividend exclusion, whatever you want to call it. I'm sure somebody will rip me apart for saying it wrong and put it on Reddit that I said it wrong, but who cares? If you're a corporation and you buy a stock of another company and you receive a dividend, you will only pay tax on half of that. Boom. Okay, little review here to make sure we got it. The important things. Cost basis is what you pay. Proceeds is what you sell it for. The difference is your gain. Do not think that your gain is proceeds, okay? So what are the three things that are capital gains? A mutual fund distribution. Now remember something. Everything about a mutual fund is taxable. The dividends they pay, the capital gains, even if you choose to reinvest it, it's considered taxable and you have to pay. Reinvestment doesn't help you on anything. Anytime you get money from a corporation or something, it is taxable. Okay? Even if you choose to automatically reinvest it and you never actually see the money, it's kind of like phantom income. You're paying taxes on money you didn't get. But but the money you put in, since you're paying taxes on it, will jack up your cost basis. Even though dividends don't reinvest, oh my God, I'm going to die. Even reinvesting the money does. It's 11:30 at night. I apologize. I'm rambling. But again, three things: a buy and a sell, option expiration. Remember, it's always short term because options are short term. Don't give me that leap crap. If they'll say leap. Okay, a leap is a long-term equity option that could be over a year, it could be up to 3 years or 39 months or 36 months, depending on the option. That would be there, but they're not talking about that. So again, buy and a sell, option expiration, and a mutual fund capital gain distribution. Those are capital gains. Also, this is very important. The three things that do not affect cost basis. Selling a call against your stock position does not impact cost basis. Getting a dividend does not impact cost basis. And accrued interest does not impact cost basis. So let's go. We got this, guys. Please, if you like what I'm doing, please hit like. Please hit subscribe. I'm almost at 2,000. And share this shit. Please, I'm trying to help everyone. I'm trying to give back. Good luck, y'all. Also, I have my podcast, Blue Collar Finance. Blue Collar Finance is not Series 7 related. I'm trying to give some financial literacy so that people who listen to it when they hear, oh, we talk about a bond or a CMO, they know what the hell they're mentioning. It's that's why I call it blue collar finance, because I'm trying to help the normal person. Everyone, good night and have a good